Good morning, Miss Vy, and welcome to our group presentation. So today, our Group 1, will present about asset classes and financial instruments, and there are four main parts in our presentation. The first two will be about the money market, which is presented by Minh Sơn and I, Thi Phuong Vy, and the next two will be presented by Châu Khoa and my teammate Hoàng Long, which is about the bond market. And our presentation starts now.
Hello teacher and everyone, my name is Sung and I will take on 5 main types of the money market instruments. But before going deeply into some particular types of it, allow me to take briefly the definition of the money market. The money market refers to the trading of the very short-term debt investment. It involves substantial trades between institutions and dealers at a wholesale level. Retail money market accounts opened by bank clients and money market mutual funds purchased by individual investors are also included. The money market is a part of the fixed income market, which has a predetermined income or an income according to certain income computing formulas. Most money market instruments are considered practically low risk, marketable, high liquidity, and have short-term maturity, usually less than 1 year. Speaking of these instruments, there are 8 main types that Thi Phuong Vy and I would like to introduce to you, which are T-bills, certificate of deposit, commercial paper, banker's acceptance, euro dollars, repo and reverse repo, Fed funds, and the last one is broker's cold loan. Okay, let's start with the first risk-free asset, treasury bills, aka T-bills. This financial asset is known to be an asset with the highest marketable of all money market instruments and very low in transaction cost, resulting in having a low price risk. It has a short time to maturity. It could be 4, 13, 26 weeks, or a year. Its par value is $100 for each, but $10,000 would be more common in the current market. Incomes from T-bills will be exempted from all state and federal taxes. The government raises funds from this asset by publicly selling it at a face value. Then those buyers will buy it at the market price. So the profit from this type of investment would be the difference between the face value and the market value. One last thing about this kind of asset is that the bid and ask price they show in the bond table is just the yield in percentage, not the actual price, which means that you have to multiply it with the face value to get the full price you must pay to have that asset. That's all for the T-bill. Now let's move to this next financial instrument, Certificate of Deposit CD and Commercial Paper CP. About CD, it's like a saving account but transferable. At maturity, the bank will pay back the interest as well as the principal to depositors. CDs with a par value greater than $100,000 would be easier to transfer than those that is lower. About CP, this kind of instrument doesn't have any tax-secure asset. Non-financial prestigious companies are likely to issue CP to raise funds rather than directly borrowing money from the bank. The maturity of this could be 1 to 2 months or up to 9 months. Time longer than this would need confirmation by the U.S. Securities and Exchange Commission. CP's par value is multiples of $100,000. In recent years, there's been a big jump appearance of those asset-backed commercial paper, which is commercial paper with secure asset issued by the bank and transacted based on its regulation. For further information, this factor is also one of the main reasons leading to the subprime mortgage crisis in the U.S. from 2007 to 2009. And that's it for the CD and CP. Now we come to the last group of financial instruments, which are banker's acceptance and euro dollar. About banker's acceptance, it's like an offer that the seller sends to the bank to require payment for the buyer at a later date in the future within 6 months. These instruments, after being approved, will be traded in the market and sold at a discount price due to the payout order. Banker's acceptance is found to be one of the safest type of investment thanks to the bank's guarantee. And for the last one, euro dollar. It seems to me that this term is a little bit confusing for all of us when we first approach, so let me get this straight once and forever. Euro-dollar is all deposits identified as US dollars at foreign banks or at overseas branches of American banks. Just because people call it Euro-dollar, it doesn't mean that all Euro-dollar has to be dollars at European banks. Euro-dollar deposits mostly have a great level of cash and a time to maturity less than 6 months. And that's all for my part. Thank you very much for listening, and please welcome our next member, Thi Phuong Vy.
So now I will continue with the second part of the money market. So we have the second part here. I will begin with the repos and reverse. So dealer in the government security use repurchase agreement, usually called repos or RPS, as a form of short-term, usually overnight borrowing. So the dealer sell the government securities to an investor on an overnight basis with an agreement to buy back those securities in the next day and with a slightly higher price. So the increase in price that we can see is an overnight interest, and the dealer thus take out a day loan from the investor, and the securities here they serve as a collateral. And we can see on the screen, we can see the definition of the term repos is essentially an identical transaction, except that the term of the explicit loan can be 30 days or more, and repos are considered very safe in terms of credit risk because of the loans are backed by the government securities. And we have the next one is a reverse repos. It's a mirror image of a repo. Here, the dealer finds an investor holding government securities and buys them, agreeing to sell them back at a specified higher price on a future date. So this is all for the repos and reverse. Yes, so next I'm gonna talk about the federal funds. So we have each bank of the Federal Reserve System, we usually call it the Fed, is required to maintain a minimum balance in reverse account in the Fed. So the required balance depends on the total deposits of the bank's customer. We have the funds in the bank reserve account are called the federal funds, or usually called the Fed funds. And at any time, some banks have more funds than required at the Fed, and other banks, primarily big banks in New York or in other financial centers, tend to have a shortage of federal funds. So in the federal fund market, banks with excess funds will lend to those with a shortage, and these loans, which are usually overnight transactions, are arranged up an interest rate called the federal fund rate. So next I will introduce about the broker call. So individual who buy stocks on the margin borrow part of the funds to pay from the stock from their broker. So the broker in turn may borrow the funds from a bank, agreeing to repay the bank immediately, but of course on the call if the bank requests it. So the rate paid on such loans is usually about 1% higher than the rate of short-term T-bills. So the next one I would love to talk about is about the LIBOR market. So we have the LIBOR market, or we usually say London Interbank Offer Rate. Is the rate in which large banks in London are willing to lend money among themselves. This rate, which is quoted in dollar and denominated loans, had become the premier short-term interest rate quoted in the European money market, and it serves as a reference for a wide range of transactions. For example, a corporation might borrow a floating rate equal to LIBOR plus 2%. Okay? So that's it for the LIBOR, and let's come to the next part. Okay, so this is the last part in my part as well as in the money market. So we have the yield on money market instrument. So on the most money market securities are low risk, they are definitely not risk-free. So the securities of the money market promise you is greater than those at default free T-bills, so at least in part because of the greater relative riskiness. So in addition, many investors require more liquidity, thus they will accept lower yields on securities such as T-bills that can be quickly and cheaply sold for cash. So we have on the screen here is the figure 2.2, show that the bank cities, for example, consistently paid a premium over T-bills. Moreover, that premium increased with the economic crisis, such as the energy price shock associated with two OPEC disturbance. We can see here is the Penn Square Bank. The stock market crashed in 1987, or in 1998. There was a collapse of long-term capital management, and of course, we can see all the top and all the bottom that is described in the time allocation that is shown in the picture. And we have to also to mention about the credit risk, beginning with the breakdown of the market. The breakdown of the market in subprime mortgage beginning in the latest year in 2007. And yes, that's it for my part. And please welcome my teammate who introduce about the bond market. So please welcome Joe Khoa to our presentation. Thank you for listening.
About the bond market, I will show you guys the definition. First of all, it's composed of longer-term borrowing and debt instruments than those that are traded in the money market. And second, it includes treasury note and bond, corporate bond, municipal bond, mortgage security, and federal agency debt. Considering the treasury note and bond, the treasury note are easy with the maturity ranging up to 10 years, while the treasury bond are easy with the maturity ranging up from 10 to 30 years. Both note and bond are commonly traded in a par value of $1,000. Although they are typically traded in the denomination of $1,000 par value, prices are quoted at a percentage of par value. Bond note and bond make semi-annual interest payment called coupon payment. The yield to maturity reported in the financial pages is calculated by determining the semi-annual yield and then doubling it, rather than comparing it for 2 half-year periods. And the yield is quoted on an annual percentage rate. I will show you guys an example how to calculate the bid price, the ask price, the yield to maturity, and the price the previous day. As we know, the prices are quoted at the percentage of par value. So we have the bid price and the ask price equal the par value $1,000 multiplied with the bid or the ask, so that the bid price equal 1,380 and the ask price equal 1,381. And the yields correspond to a yield of 2.378%. The ask price fell 0.9375 from its level yesterday, so the ask price must have been $1,319. Considering inflation-protected treasury bond, the first one, in the U.S., inflation-protected treasury bond are called TAPS, and the second one, the principal amount on the bonds is attracted in the proportion to increase the consumer price index, and therefore they provide a constant stream of income in real dollar. And the third one, yields on TIPS bond should be interpreted as real or inflation-adjusted interest rate.
Firstly, I will talk about the federal agency debt. Some government agencies issue their own security to finance their activities. These agencies usually are formed to channel credit to a particular sector of the economy that Congress believes might not receive adequate credit through normal private sources. Below here, you can see the major mortgage-related agencies. They are Federal Home Loan Bank, Federal National Mortgage Association, Government National Mortgage Association, and the last one, Federal Home Loan Mortgage Corporation. This topic I will talk about international bonds. Nowadays, many firms borrow abroad and many investors buy bonds from foreign issuers. In order to declare rightly, there is a thriving international capital market, largely located in London. In here, a euro bond is bond denominated in a currency other than that of the country in which it is issued. For example, a dollar-denominated bond sold in Britain would be called a euro-dollar bond. Similarly, investor might speak of a European bond, yen-denominated bond sold outside Japan. Because the European currency is called euro, the term euro bond may be confusing. So it's best to think of them simply as international bonds. This topic I will talk about international bonds. Nowadays, many firms borrow. Thirdly, I will talk about municipal bonds. Municipal bonds are issued by state and local governments. They are similar to treasury and corporate bonds, except that their interest income is exempt from federal income taxation. So the general obligation bonds are backed by full faith and credit of the issuer, and an industrial development bond is a revenue bond that is issued to finance commercial enterprises, such as the construction of a factory that can be operated by a private firm. Like the treasury bonds, municipal bonds vary widely in maturity. A good deal of a debt issue is in the form of short-term tax anticipation note, which raise funds to pay for expenses before actual collection of taxes. Uh, other municipal debt is long-term and used to fund large capital investment. Maturity usually range up to 30 years. So the key feature of municipal bonds is their tax exempt status. Because investors pay neither federal nor state taxes on the interest proceeds, they are willing to accept lower use on the security to determine the interest rate taxable bonds, which set after tax yield equal and so for the equivalent taxable yield of the tax exempt bonds. And this the rate taxable bonds much offer to match the after tax yield on the tax-free municipal. Lastly, I will talk about corporate bonds. Corporate bonds are the means by which private firms borrow money directly from the public. These bonds are similar in structure to treasury issues. They typically pay semi-annual coupons over their lives and return the face value to the bondholder at maturity. And corporate bonds sometimes come with a option attached. They are callable bond and convertible bonds. The callable bonds give the firm the option to repurchase the bond from the holder at a stipulated call price, and convertible bonds give the bondholder the option to convert each bond into a stipulated number of share stock. And that is the end of our presentation. Thank you for listening.